Welcome to Chapter 10 of the RFP Program Module 2. This chapter shifts our focus from the legal principles that govern insurance contracts, which we covered in Chapter 9, to the regulatory ecosystem that protects consumers and governs the professional conduct of insurance practitioners. Where Chapter 9 asked what makes a contract valid, Chapter 10 asks how the industry ensures that contracts are sold fairly, products are designed ethically, and agents meet minimum professional standards. The subtitle references three pillars: Consumer Protection, FSA 2013, and the Life and General Insurance Codes of Practice. These correspond to the major sections of the chapter. Consumer rights establish the philosophical foundation. The FSA 2013 translates those rights into enforceable law. The LIAM-BNM Code of Good Practice and the PAM Code of Ethics provide the self-regulatory detail that governs day-to-day operations. The Qualitative Control Guidelines, QCG, then ensure that only qualified, productive agents remain in the industry. By the end of this topic, students should be able to understand consumer rights, the role of life insurance companies and their agents towards policy owners, the importance of LIAM and PIAM in the industry, and the regulatory controls embedded in the QCG for agents to enhance their professionalism. This slide presents the four-layer regulatory ecosystem that governs the Malaysian insurance industry, depicted as concentric rings. Each layer builds on and reinforces the others. The outermost ring is the foundation, Consumer Rights and the Financial Services Act 2013. This is the statutory layer that establishes the legal rights of consumers and the enforceable obligations of insurers and agents. Everything else operates within this boundary. The second ring is the blueprints, the LIAM and BNM Life Insurance Codes of Practice. These are industry self-regulatory guidelines that translate the broad principles of the FSA 2013 into detailed operational rules covering product design, brochures, sales illustrations, proposal forms, policies, and information statements. They function as an engineering blueprint, specifying mathematical formulas and structural constraints. The third ring is the sentinels, the PIAM General Insurance Code of Ethics. This governs the conduct of general insurance intermediaries, focusing on sales principles, contract explanation, and underwriting disclosure. While the life insurance codes emphasize product structure and actuarial integrity, the PIAM code emphasizes behavioral conduct at the point of sale. The innermost layer is the architects, the Qualitative Control Guidelines, QCG, for agency professionalism. These set the entry requirements, promotion criteria, maintenance standards, and disciplinary consequences for the agency force. They ensure that only qualified, productive, and ethical agents remain in the system. This slide presents the consumer rights framework as defined by the International Consumer Movement. According to this international body, there are 7 basic rights for the consumers of a product or service. The slide presents these 7 rights plus an editorial connecting point about their translation into financial legislation. The right to satisfaction means that the customer should receive reasonable satisfaction from the services or goods they purchase. In insurance terms, this means the policy should deliver on its promises. The right to information means the customer has the right to demand all necessary information on products or services needed to make an informed decision. For insurance, this includes understanding what is guaranteed and what is not. The right to choice means the customer must not be forced or tricked into making a wrong decision. This directly prohibits pressure selling and deceptive sales tactics. The right to basic needs means the customer has a right of access to purchase goods or services deemed necessary for survival and a reasonably comfortable lifestyle. The right to be heard means there should be a platform for consumers to voice grievances over unsatisfactory goods and services. In the insurance context, this is served by the LIAM Advisory Service Center and the Insurance Mediation Bureau. The right to consumer education means the right to receive information that affects or may affect their choices and decisions on goods and services. The right to a safe and clean environment means the right to have the environment protected against pollution and hazardous materials that may harm health. The slide also includes a financial translation box noting that the FSA 2013 directly translates these universal rights into hard legislative shields for insurance policy owners. While not all 7 consumer rights are equally applicable to the insurance industry, those that are relevant have been adopted in the new legislation. The Financial Services Act 2013 is specifically designed to safeguard and protect the rights of consumers of insurance products, including additional measures to ensure fairer terms for policy owners. This slide presents the first set of FSA 2013 consumer protection provisions, covering the life cycle from pre-sale to midterm of the policy. The first protection is product approval. Before any new life product can be launched to the public, the insurer is required to submit to Bank Negara Malaysia the particulars of the product, together with its certification by the appointed actuary, the prospectus or other sales literature, the specimen policy, and other supporting information. This submission must be made at least 30 days before launching the product. The purpose is to prevent the sale of policies that are disadvantageous to buyers. BNM acts as a gatekeeper, ensuring that no product reaches the market without regulatory scrutiny. The second protection concerns inducement and transparency. The Act provides that consumers are entitled to refunds if they were induced to purchase an insurance policy based on misleading, false, or deceptive statements, concealment of material facts, or the use of brochures or sales illustrations not authorized by the insurer. The consumer is also entitled to a refund if they handed over money to a person carrying on insurance business illegally. This provision directly enforces the consumer's right to information and right to choice. The third protection is disclosure waivers. When a proposer fails to answer or gives an incomplete answer to a question in the proposal form or queries by the insurer, and the insurer does not pursue the matter further, the insurer is deemed to have waived the need for compliance with the disclosure requirement. The policy will not be avoided on those grounds. This protects consumers from insurers who accept incomplete information at the point of sale and then attempt to void the contract later when a claim is made. The fourth protection concerns surrender and free look provisions. The Act liberalizes the terms governing surrender of life policies. A policy owner can surrender a single premium policy at any time. Any other life policy can be surrendered once it has a cash value. The Act also allows insurers to provide surrender values for policies in force less than 3 years if they choose. For the free look provision, the Act allows policy owners to return a policy shortly after issue if they have objections. However, when the premium is refunded, the insurer may deduct the cost of any medical examination that was conducted. This slide continues the FSA 2013 consumer protection provisions, covering claims, pricing controls, and systemic security. The first provision closes the insurable interest loophole in group policies. Section 186(3) of the Act sets out the rights of a person insured under a group policy where the group policy owner has no insurable interest in the life of the person insured. If the insured person has paid the premium to the group policy owner, the person insured retains their rights regardless of whether the licensed insurer has actually received the premium from the group policy owner. This prevents a situation where an individual pays for group coverage but loses protection because of administrative failures by the group policy owner. The second provision is the 4% delay penalty. Under Section 161(1), when a claim is made under a life policy or personal accident policy following the death of the policyholder, and the insurer fails to pay the policy monies within 60 days of receipt of the claim, the insurer must pay a minimum compound interest of 4% per annum, or such other rate as may be prescribed, on the unpaid amount. This creates a strong financial incentive for insurers to process death claims promptly. The third provision concerns price control and tariffs. The Act empowers Bank Negara to call upon an insurer or an association of insurers to review and justify premium rates. If BNM considers it necessary, it can require the insurer to increase or reduce those rates. Additionally, insurers must obtain BNM's approval before they can adopt any tariff of premium rates or tariff of policy terms and conditions. This ensures that consumers are not forced to pay more than what is reasonable. The fourth provision covers winding up and transfers. When an insurer is wound up, a life policyholder is entitled to the actuarial valuation reserve in respect of their policy. Furthermore, the Act provides that liabilities to policyholders and claimants shall have priority over unsecured liabilities other than preferential debts. When an insurer's business is transferred to another entity, the transferee must confirm that policyholders, claimants, and other creditors will not be adversely affected. This slide presents the minimum entry requirements for the insurance agency force and the strict rules governing appointments, as prescribed by the QCG guidelines issued under the BNM Operating Costs Control Framework. The baseline entry requirements are straightforward. The agent must be at least 18 years old and must have completed SPM or MCE. The agent must pass the pre-contract examination, PCE, administered by the Malaysian Insurance Institute, MII, and must be registered with LIAM. Within 6 months of appointment, the agent must complete 20 hours of training, either through MII or through in-house training approved by LIAM. The agent must not be an undischarged bankrupt, and should not have been involved in criminal acts or acts of dishonesty. The agent must confirm these facts before appointment, and any non-disclosure or inaccurate disclosure of past conduct is sufficient ground for termination. The direct appointment ban is one of the most significant QCG provisions. There shall be no direct appointment of career agents or agency leaders from outside the industry. However, an insurer may appoint a career agent or agency leader who was working in an equivalent position with another insurer, subject to 3 conditions. The person must have met the minimum maintenance criteria with the preceding insurer, the preceding insurer must give a clean financial discharge, and there must be no direct or indirect monetary incentives given to encourage the movement. This last condition is critical. It explicitly prohibits the practice of buying over agents from competitors. There is an exception for internal staff. Clerical staff with 3 continuous years of service in the life insurance industry can be given direct appointment as agency supervisor. Executive staff with 5 continuous years of service can be directly appointed as agency manager. However, staff appointed as leaders receive no special financing or subsidy beyond what is available to ordinary agents or agency leaders. This slide presents the 3-step promotion pathway from agent to career agent, from career agent to supervisor, and from supervisor to manager. Each step requires meeting specific quantitative thresholds. Step 1, from agent to career agent, requires 4 criteria. The agent must have a persistency rate of 80% on premium count over 2 consecutive years prior to promotion. The agent must have sold at least 24 policies per year over 2 years. The agent must have achieved an aggregate personal production of RM80,000 in first-year premium, FYP, over 2 years, with a minimum of RM30,000 in the first year. Finally, the agent must have completed a minimum of 20 hours of advanced life insurance training through MII or approved in-house programs. Step 2, from career agent to supervisor, requires meeting the same persistency, volume, and production thresholds as Step 1, 80% persistency, 24 policies per year, RM80,000 aggregate FYAP with RM30,000 minimum in year 1. However, 2 additional requirements are introduced. The agent must introduce 3 potential agents to their agency leader prior to promotion, and upon promotion these agents are transferred to the new supervisor. The agent must also complete a minimum of 30 hours of agency management coursework. Step 3, from supervisor to manager, introduces significantly higher thresholds. The agency leader must not hold a salaried job elsewhere, demonstrating full-time commitment. The leader must have completed 30 hours of agency management coursework. They must have a minimum of 36 months of service as supervisor with the same insurer. The group production requirement is RM600,000 FYP aggregate over 3 years, with minimum yearly thresholds of RM150,000 in year 1, RM200,000 in year 2, and RM250,000 in year 3. Alternatively, a fast-track promotion within 2 years is available. This slide presents the ongoing maintenance requirements for each rank in the agency hierarchy, along with the consequences of failure. For an ordinary agent, the maintenance requirement is a minimum first-year annual premium of RM6,000 per year or 12 policies, plus a minimum first-year persistency of 80%. If the agent fails to meet these requirements twice, Their contract is terminated and they must wait 1 year before being reappointed and re-registered with Liam. For a career agent, the maintenance requirement is RM 40,000 FYAP per year involving at least 24 policies, plus 80% persistency. If a career agent fails to meet maintenance requirements twice, they are demoted and must wait 1 year. When a career agent is promoted to supervisor, the career agent receives production credit, 50% of the FYAP of the newly appointed supervisor's unit in the first year of promotion, and 25% in the second year. For a supervisor, the maintenance requirements include RM 75,000 FYAP per year for the direct unit, 80% persistency on premium count for the direct unit, a minimum of 3 qualifying agents in the unit, 20 hours of training every 3 years, and compliance with Liam's Code of Ethics. The maintenance criteria only apply 1 year after promotion. If a supervisor fails twice, they are demoted with a 1-year waiting period. For a manager, the maintenance requirements include RM 200,000 FYAP per year in the group with a minimum of 8 qualifying agents, plus 75% persistency on premium for the group. When a manager's supervisor is promoted, the manager receives 50% production credit in the first year and 25% in the second year. If a manager fails twice, they must re-qualify after a 1-year waiting period. This slide presents the 4 relief mechanisms built into the QCG system, recognizing that rigid enforcement without flexibility would be both unfair and counterproductive. The first is the grace period. A 1-year grace period is universally allowed for make-up production before demotion occurs. This applies across all leadership ranks, supervisor and manager. The grace period gives the agency leader time to recover from a poor year without immediate consequences. The second is the 50% seniority waiver. Maintenance production requirements are halved, up to age 70, for veterans who meet either of 2 criteria, age 55 or more with over 15 years of service, or over 20 years of service regardless of age. This recognizes that long-serving veterans have built substantial books of business and may be transitioning to mentoring and training roles rather than active selling. The third is the critical illness waiver. A total 100% waiver of maintenance requirements is granted in cases of critical illness or total permanent disability, up to a maximum of 5 years. This is a compassionate provision that prevents the system from penalizing agents who are physically unable to work due to serious health conditions. The fourth element is the ethical anchor. Across all ranks, waivers, and relief mechanisms, absolute compliance with the Liam Code of Ethics remains a non-negotiable maintenance requirement. No amount of production can substitute for ethical conduct. An agent who meets all quantitative targets but violates the Code of Ethics is still subject to disciplinary action. This slide presents the Life Insurance Association of Malaysia, Liam, and its dual role as both an industry development body and a self-regulatory authority. Liam was formed in 1974 and currently represents 18 life insurance companies in Malaysia. Liam's core objectives are to promote public understanding and appreciation for life insurance, to improve the image of the life insurance industry through self-regulation, to give support to the regulatory authorities, particularly Bank Negara, in developing a healthy industry, to enhance the professionalism of its staff and agents through continuous training and education, and to work with local and foreign life insurance organizations towards achieving common objectives and benefits. Liam's key activities include formulating rules and regulations to maintain discipline in the industry, maintaining a central computer database containing vital statistics and information of the industry, operating the Liam Advisory Service Center to provide assistance in handling public complaints and inquiries, organizing community service projects and public relations activities, organizing seminars and conferences to promote the life insurance industry, holding regular consultation with Bank Negara Malaysia on issues facing the industry, and disseminating information through publication of research material, quarterly bulletins, and annual reports. This slide covers parts 1 and 2 of the BNM Code of Good Practice for Life Insurance, which establish the accountability framework and the product design constraints. Part 1 establishes personal accountability at the highest level. The Chief Executive Officer and the appointed actuary are individually responsible for compliance with the code. This means compliance is not a collective or corporate responsibility that can be diffused. Specific individuals are accountable. Any intentional disregard of the code, or lack of diligence to comply with it, renders the person not fit and proper to hold their position in the licensed life insurer. This is the most severe consequence in the self-regulatory framework: loss of the right to hold office. Part 2 prescribes the constraints on product design. The no deceptive packaging rule requires that a pure endowment assurance plan must provide for the refund of premiums paid in the event of death before the maturity date. Extensions to a life policy must not be made compulsory, whether for 1 year or for the duration of the policy, nor should they be sold on a package basis. This prevents insurers from bundling unwanted riders with base policies. The proportionality constraints ensure that extensions and death benefits remain proportionate to the base policy. The sum insured by an extension cannot exceed 5 times the sum insured by the base policy. A life insurance product must not be designed to provide a death benefit more than 5 times the guaranteed amount payable upon survival. The bonus strictures impose specific limits on bonus declarations. The period of deferment for participation in profits must not exceed 3 years from inception. After the 5th policy year, the bonus declared for any year shall not exceed 125% of the bonus declared for the immediately preceding year. Any terminal bonus must be payable on both death and maturity. The terminal bonus is capped at the lower of 80% of the vested bonus or RM25 per RM1000 sum assured per policy year. The financing constraint prohibits designing or marketing life insurance products on the basis that premiums will be financed by policy loans. This prevents a circular structure where the policy's own value is used to fund the premiums that create that value. This slide highlights one of the most significant consumer protection measures in the B&M Code, the complete prohibition on vanishing premium representations. Point 1. B&M strictly forbids naming or describing any product as a vanishing premium. This prohibition appears in 2 separate parts of the code. In Part 2, Product Design, Paragraph 5(i), states that a product must not be described as vanishing premium. In Part 5, Brochures, Paragraph 17 reinforces that a brochure shall not describe any product as vanishing premium. The dual prohibition ensures the ban applies to both the product name and all marketing materials. Point 2. Insurers cannot represent that premiums are not required for each year of the premium payment term of the policy. Under Part 6, Sales Illustrations, Paragraph 26(i), insurers are also prohibited from illustrating premiums being financed through automatic policy loans. Point 3. Where a life insurer does illustrate future premiums as being financed from non-guaranteed benefits, the code imposes strict disclosure requirements. The illustration must show the impact of such payments on future benefits by comparing the benefits without using this facility against the benefits using the facility. The insurer must emphasize that depending on actual results, the policy owner may need to continue or resume premium payments. Where a policy carries a rider, the entire premium including the rider premium must be covered by this feature. This slide covers 3 parts of the B&M Code that regulate the key documents in the insurance transaction: the proposal form, Part 3, the life policy, Part 4, and the policy information statement, Part 7. Part 3 governs the proposal form. The form must be written in clear, simple language. Questions must be specific and must not require the proposer to guess what information should be provided. The form must incorporate 3 mandatory notices: the notice required under Section 149(4) of the Act regarding the duty of disclosure, a notice that proof of age will be required, and a notice that the proposer should ask for and study the brochure and sales illustration, paying particular attention to benefits that are guaranteed versus those that are not. Any questions regarding extensions must explicitly state that purchase of such extensions is not compulsory and is entirely at the proposer's discretion. Part 4 governs the life policy itself. Where the insurer provides provisional insurance protection from the date of receipt of a payment towards the premium, the receipt must specifically state the terms, conditions, and limitations of that protection during the period up to the date of policy issue. The policy shall not contain any exclusion of protection other than those prescribed, without the prior written approval of Bank Negara. The policy must include a nomination form that explicitly states three things: that a nomination under Section 166 of the Act creates a trust in favor of the nominee, that the policy owner should appoint a trustee for the policy monies, and that if the nominee is not a spouse, child, or parent under Section 166, the policy owner should assign the policy benefits to the nominee. Part 7 governs the policy information statement, which must be issued together with the life policy. It must include information on premium payment facilities, the facility for nomination, the facility for policy loans, the availability of a surrender value with a caution that the policy owner will lose if they surrender, the contact person or office for inquiries, and the importance of advising the insurer of any change of address. It must also inform the policy owner about the provisions of Section 148 of the Act and about the availability of the Insurance Mediation Bureau, its address, and its role in dispute resolution. This slide covers Part 5 of the BNM Code, which regulates brochures, announcements, advertisements, and all point-of-sale materials. The actuarial veto is the first line of defense. A life insurer or its agent shall not issue or use a brochure providing information on non-guaranteed benefits unless the release of such information has been authorized by the appointed actuary. This gives the actuary a direct veto over marketing materials, ensuring that no non-guaranteed projection reaches consumers without actuarial scrutiny. The language and scale requirements mandate that brochures be written in simple, unambiguous, and easily comprehensible language. Technical or industry terms must not be used without a clear explanation. Critically, the same type style, size, and general layout that are applied to any main statement must also be used for stating any qualification or disclaimer. This prevents the common practice of making bold claims in large print and hiding qualifications in fine print. All graphs and diagrams must be drawn to scale. The key future statement requirements mandate that every brochure used as point-of-sale material must contain a simple statement describing the product and its main objectives, details of the events triggering benefits and the form of benefit payments, circumstances in which exclusions or restrictions apply, details of the premium obligations including amount, frequency, and term, and the implications of ceasing premium payment. The mandatory warnings require two specific notices to be included. The first states that the policy will not have a cash value on termination until after the policyholder has paid premiums for 3 years. The second states that if the policyholder terminates the policy in the early years, they may get back less than the amount they paid in. A third notice asks the proposer to satisfy themselves that the plan best serves their needs and that the premium is affordable. This slide covers Part 6 of the BNM Code, which governs the sales illustration that must be provided to the proposer at the point of sale. Unlike the brochure, which is a general marketing document, the sales illustration is specific to the individual proposal and shows the actual premiums and benefits applicable to that proposer. The separation rule is fundamental. The sales illustration must clearly separate guaranteed benefits from non-guaranteed benefits. It must emphasize that non-guaranteed benefits are not guaranteed and that the quantum declared in future may be less or more than the values illustrated. Non-guaranteed benefits must be shown separately from guaranteed benefits. This prevents the blending of certain and uncertain values into a single misleading total. The risk transparency requirements mandate that the illustration must contain a clear statement of any risks borne by the policy owner with respect to the benefits under the plan. Any reference to past performance must include a statement that past performance may not be a guide to future performance. The rider isolation rule prohibits illustrating the cost and benefits of an extension or rider together with the base life policy. Each must be shown separately so that the proposer can clearly see what the base policy delivers and what the rider adds. This prevents riders from inflating the apparent value of the base policy. The actuarial maintenance requirement mandates that the appointed actuary must review the appropriateness of all assumptions at least once every 2 years. The illustration must show values as at the end of each policy year for years 1 to 20, and every 5 years thereafter until maturity or the age of 70 years. This provides a long-horizon view that helps the proposer understand the policy's trajectory. This slide presents the specific maximum assumptions prescribed in paragraph 28 of the BNM Code. These are the hard constraints that actuaries must work within when demonstrating through profit tests that non-guaranteed benefits can be supported. No non-guaranteed benefits can be illustrated unless they pass a profit test based on assumptions no more favorable than these. Investment return is capped at the lower of the average actual investment return during the preceding 5 years or 8.5% per annum. This prevents insurers from using optimistic return assumptions to inflate illustrated benefits. Mortality must be based on the Malaysian mortality table, 83 to 88, male ordinary life, with a 3-year age setback for female lives. This standardizes the mortality assumption across the industry. Income tax is fixed at 8% on investment income. This prevents insurers from using unrealistically low tax assumptions. Management expenses are locked at an aggregate of 12% of the premium plus RM160 for the first policy year, and 3% of the premium plus RM40 for each subsequent year. However, if an insurer can demonstrate that its actual expenses are lower than these figures, it may use those lower amounts. Withdrawal rates are prescribed at 10% in year 1, 10% in year 2, 3% for each year from year 3 to year 30, and 0% thereafter. This reflects the expected pattern of policy lapses. Valuation reserve must be calculated on the statutory valuation basis. This prevents insurers from using more aggressive valuation methods to make policies appear more profitable. This slide introduces Persatuan Insurans and Malaysia, PIAM, the General Insurance Industry Association, and its regulatory structure. PIAM's mandate covers 3 areas: promoting and protecting the interests of its members, regulating the conduct and activities of all insurance companies engaged in general insurance business, and monitoring the tariffs, commissions, and remuneration applicable to general insurance business. Importantly, the PIAM code does not apply to reinsurance business. To achieve these objectives, PIAM's Management Committee appoints a board with specific powers to receive and consider applications for registration as registered agents, to issue, renew, or extend certificates of registration, to monitor and control the conduct and activities of registered agents, to recommend appointment of a registrar, and to consider and approve appeals for exemptions from the regulations. The overriding principle of the PIAM Code of Ethics is that it shall be an obligation of an intermediary at all times to conduct business with utmost good faith and integrity. In the case of complaints from policyholders, the insurance company shall require the intermediary to cooperate so that the facts can be established. The intermediary must inform the complaining policyholder that they can take the problem directly to the insurance company. This slide introduces Persatuan Insurans and Malaysia, PIAM, the General Insurance Industry Association, and its regulatory structure. PIAM's mandate covers 3 areas: promoting and protecting the interests of its members, regulating the conduct and activities of all insurance companies engaged in general insurance business, and monitoring the tariffs, commissions, and remuneration applicable to general insurance business. Importantly, the PIAM code does not apply to reinsurance business. To achieve these objectives, PIAM's Management Committee appoints a board with specific powers to receive and consider applications for registration as registered agents, to issue, renew, or extend certificates of registration, to monitor and control the conduct and activities of registered agents, to recommend appointment of a registrar, and to consider and approve appeals for exemptions from the regulations. The overriding principle of the PIAM Code of Ethics is that it shall be an obligation of an intermediary at all times to conduct business with utmost good faith and integrity. In the case of complaints from policyholders, the insurance company shall require the intermediary to cooperate so that the facts can be established. The intermediary must inform the complaining policyholder that they can take the problem directly to the insurance company. This slide covers Section C of the PIAM Code of Ethics, which governs the disclosure of underwriting information. This section addresses the intermediary's obligations when obtaining the completion of the proposal form or any other material document. Complete accuracy requires the intermediary to take all reasonable steps to ensure that the necessary proposal forms are completed fully and accurately by each prospective policyholder. The emphasis is on reasonable steps. The intermediary is not expected to verify every statement independently, but must ensure the process is thorough. No interference prohibits the intermediary from preventing a prospective policyholder from stating material facts to the insurance company, and from inducing the prospective policyholder to make a misrepresentation to the insurance company with regard to material facts. This echoes the duty of utmost good faith discussed in Chapter 9 but applies it specifically to the intermediary's conduct. Client accountability requires the intermediary to avoid influencing the prospective policyholder's answers and to make it unequivocally clear that the client is the ultimate person who will be responsible for the answers given. This creates a clear line of accountability that protects both the intermediary and the insurer. Consequence warning requires the intermediary to ensure that the consequences of non-disclosure and inaccuracies are fully understood by the prospective policyholder. The intermediary must draw the client's attention to the relevant statement in the proposal form and explain the consequences. This is not a passive obligation. The intermediary must actively explain what happens if information is withheld or incorrect. Agent duty to principal requires the intermediary to make all reasonable inquiries to gauge the existence of risk and to actively highlight any circumstances which may adversely affect the risk to be underwritten, to the principal, insurer. This means the agent has a dual obligation, to the client, to explain consequences, and to the insurer, to flag adverse risks. This slide presents a comparative analysis of the two regulatory paradigms governing the Malaysian insurance industry. The life insurance regulatory framework, governed by LIAM and the BNM Code, operates on a long-term horizon. Life insurance products span decades, so the primary regulatory concern is long-term actuarial sustainability. The primary regulatory threat is deceptive long-term projections, vanishing premium promises, excessive bonus illustrations, and misleading investment return assumptions. The regulatory mechanism functions as an engineering blueprint, heavily dictating mathematical formulas, such as the 8.5% maximum investment return, product structure constraints, such as the 5x proportionality limits, and bonus declaration rules, such as the 125% year-over-year cap. The General Insurance Regulatory Framework, governed by PIAM, operates on a short-term horizon focused on annual risk mitigation. General insurance policies are typically renewed annually, so the primary regulatory concern is the quality of advice at the point of sale. The primary regulatory threat is poor point-of-sale conduct, unsolicited calls, failure to explain exclusions, pressure selling, and inaccurate comparisons with competitors. The regulatory mechanism functions as a behavioral sentinel, dictating agent conduct rules, requiring prior appointments, mandating transparent contract explanation, and prohibiting unfair competitive practices. Despite their different approaches, both frameworks share the same foundation: the overriding obligation to conduct business with utmost good faith and integrity, and the common goal of protecting the consumer. This final slide presents the synthesis of the entire chapter as 4 interconnected gears that must all turn together for the system to function. The first gear is the catalyst: educated consumers who are aware of their basic rights and who demand satisfaction. Without informed consumers who assert their rights, the entire regulatory framework operates in a vacuum. Consumer awareness creates the demand for accountability. The second gear is the shield, the FSA 2013. This is the statutory backbone that enforces fairer terms, mandates the 4% delay penalty for late claims payments, closes loopholes in group policy insurable interest, controls pricing, and protects policyholders in winding-up situations. The FSA 2013 gives the other gears their legal force. The third gear is the codes, LIAM and PIAM. These industry self-regulatory frameworks ensure that products are mathematically honest, through actuarial constraints and profit tests, properly explained, through brochure and sales illustration rules, and sold with utmost good faith, through the overriding ethical obligation. They translate statutory principles into operational detail. The fourth gear is the gatekeepers, the QCG standards. These ensure that only highly trained, productive, and ethically bound individuals sell insurance products. The entry requirements, promotion criteria, maintenance standards, and relief mechanisms create a career framework that rewards professionalism and removes underperformers. The synthesis insight on the slide captures the interdependence. When any single gear fails, the system fractures. If consumers are uneducated, they cannot assert their rights. If the FSA 2013 is not enforced, statutory protections are meaningless. If the codes are ignored, products become deceptive. If the QCG standards slip, unqualified agents undermine public trust. When all four gears turn together, they transform insurance from a commercial transaction into a trusted, professional advisory practice.